Okay. Okay. Last year, for several years, we had a wonderful woman who carried this meeting off without a hitch, Carrie Sova, and she just had her third child here about a few weeks ago and decided that she decided right after the last meeting that was going to be her full-time occupation. And this year, again, we've had everything carried off without me having to do anything, without a hitch. And I would just like to have Melissa Shapiro stand up. We'll get a spotlight on her. Gee. I can't believe it, how she does it. It's remarkable. I mean, I just tell her the date, and that's all the help I am, and it goes on from there. So, Melissa, thank you. Okay, I think we next go to station 10, and we will continue until 3:30. Then we'll take a 15-minute break, and at 3:45 we'll convene the actual annual meeting. Station 10.
Hi, I'm Teresa Ligozinski. I'm from Omaha, Nebraska. And I have a question about Microsoft. You have gotten into the tech world with buying Apple. You have Mr. Gates there. I'm just wondering why you've never bought Microsoft.
Well, in the earlier years, it's very clear. The answer is stupidity. But since Bill has, particularly since Bill has joined the board, but even earlier than that, because of our friendship, it just would be a mistake for Berkshire to buy Microsoft, because if something happened a week later, a month later, in terms of them having better earnings than expected or making an acquisition, anything, both Bill and I would incorrectly, but would be a target of suggestions and accusations, perhaps even, that somehow he had told me something or vice versa. I try to stay away from a few things just totally, because the inference would be drawn that I might have talked to somebody about something. So I've told the fellows, that Ted and Todd, for example, that there are just a few things that are off the list, because there'd be a lot of people that wouldn't believe us if something good immediately happened after we bought it. And of course, to buy a lot of stock, you can take 6 months to buy it or something of the sort. We just don't need it. But both that and my stupidity have cost us a lot of money. It's a good question, and I think the answer makes sense. But Charlie?
Well, it's part of theology that a late conversion is better than ever, and you've greatly improved yourself.
Becky.
All right, this question comes from Dave Shane. He says, Warren, you are a big believer in the U.S. political system, the financial system, and in every American. You've said that regardless of who is president, the economy and the U.S. consumer will continue to prosper over the long run. All that said, do you believe that people in this country are more divided today than 50 years ago, or is it just social media and media in general that blows this divide out of proportion? And if you do believe the divide has grown, what words of wisdom do you have to possibly help remedy it?
Now, I would say this: multiple times in my life, people have felt the country was more divided than ever, and I've gone through periods where people I knew and admired thought that because the other party was in power, that there never would be another election, that the Constitution would be. I've heard everything. Now, the interesting thing is, this paper from 1942, since then, there have been 14 American presidents. Just since my young venture into the stock market at 11, I've lived under 14 of the 44 presidents the United States has had. Now they call Trump 45, but they count Grover Cleveland twice. So there's really only been 44 presidents of the United States. And 14 of the 44 have been during this period when that $10,000 became 51 million. 7 have been Republicans, 7 have been Democrats. 1 has been assassinated, 1 has resigned under pressure. It works. If you'd told me at the start, that you'd have a Cuban Missile Crisis and you'd have nuclear weapons and you'd have a panic in 2000, financial panic, and you'd have many recessions, and you'd have war in the streets in the late 60s from a divided country, you'd say, why the hell are you buying stocks? And through it all, America in fits and starts, but America really moves ahead. And we survived the Civil War. I mean, I hate to think of having to do it that way, but this country, in only less than 3 of my lifetimes, if you go back 3 of my lifetimes, you go back 263 years, I guess, and Thomas Jefferson is 12 years old, and that's just 3. And there was nothing here. You've flown in from all over to Omaha today, and you flew over a country with more than 75 million owner-occupied homes and 260 million vehicles and great universities and medical systems and everything. And it's all a net gain in less than 3 of my lifetimes. So, and we've had these events since I started buying my first stock. This country really, really works, and it always will have lots of disagreements. And after every election, you'll have people feeling the world is coming to an end, and how could this happen? And I remember my future father-in-law in 1952. He wanted to have a talk with me before his daughter and I got married. So kind of reluctantly, I sat down with him, and he said, Warren, he said, there's just one thing I want to tell you. He said, you're going to fail. He said, the Democrats are going to get in, they're going to take over the country, and you're going to fail, but don't feel responsible for it because it's not your fault. I mean, he wanted to absolve me from this feeling that while his daughter was starving to death, it was my fault. And I kept buying stocks and doing a little bit better all the time. And if the Republicans were in, it was okay, and it was because of them that I was doing well. And if they were out, forget it, it was all going to disappear. So I've seen a lot of American public opinion over the years. I've seen a lot of media commentary. I've seen the headlines. And when you get all through with it, this country has 6 times the per capita GDP growth, the GDP per capita that it had when I was born. One person's lifetime, 6-for-1 change. Everybody in this room essentially is living better in multiple ways than John D. Rockefeller Sr. was, who was the richest person in the world during my early years. And we're all living better than he could live. So this is a remarkable country, and we found something very special. I would love to be a baby being born in the United States today. Charlie, you give the other side of this.
Well, there's a tendency to think that our present politicians are much worse than any we had in the past. But we tend to forget how awful our politicians were in the past. I can remember a prominent senator arguing with an absolute earnestness that mediocre people ought to have more representation on the United States Supreme Court.
Yeah, he came from Nebraska, incidentally.
He came from Nebraska. So we're not quite as bad as that yet.
Yeah. He succeeded my dad in the House of Representatives. Okay. Gary.
Yes, on reinsurance. I know we've talked in the past about reinsurance not really being as attractive an industry in, say, the next 10 years as the last 10. But I don't think we've talked specifically about General Re. And I looked this morning at the 10Q and I see General Re has grown nicely. I know there's been some changes in the management. And I wondered if you could just give us a sense of what's going on at the company to bring about some of that growth and what looks like improvement.
Yeah, well, the reinsurance business, I don't think I'd say that it's tougher than it was 10 years ago, but if you go back to 40 or 50 years ago, it was not brutally competitive, I'll put it that way. And at Gen Re, Tad Montrose, who did a fantastic job for us at Gen Re, retired, and we have under Ajit, and then Kara in addition, but under Ajit, the focus of the place has changed somewhat, and it probably is more growth oriented than before. But I can assure you that anything associated with Ajit also has underwriting discipline attached to it. But there has, as you've correctly noticed, there's been some pickup, and I think actually we'll see the property casualty reinsurance business grow a fair amount, and the life business, reinsurance business, and this is really the only place we do much in life, but that has grown very substantially ever since we took it over, particularly internationally, and so that part I like, and we will have I think we'll have a somewhat larger operation at Gen Re, but we have various methods, as you know, of being in reinsurance. We do these huge bulk deals. That's why our net revenues are down this year. We did that $10 billion deal with AIG, which was the biggest deal in history last year, and we don't have a repeat of it this year. We will be in the reinsurance business 5 years from now, 10 years from now, 20 years from now, and 50 years from now, in my view, and we will have some unusual advantages that stem both from our capital position, our attitude toward the business, and the talent that we have. We have a way better than average insurance business generally. We have some real gems that nobody really knows much about, and we have a very, very good reinsurance business that will be subject to more ups and downs than something like GEICO will be, which just moves ahead every year. But it will be an important part of Berkshire. Charlie?
Yeah, I would argue the part that any idiot financier can easily get into has gotten way tougher. And why wouldn't it?
Charlie is my substitute for my father-in-law that was... Okay, station 11.
Hey, Warren, Charlie. Thank you again for having us and having me. I just can't thank you guys enough and appreciate you guys enough for the body of work that you guys have delivered to us and the exemplar example that you guys have set with your principles. Thank you. Charlie, you've mentioned that if given the chance, or the same chance with a smaller capital base, you would still look for mispriced stock opportunities.
Of course.
and that would be determined through obviously what we call the intrinsic value of the organization or the company in question, an aggregate of the discounted future cash flows. Would you work the arithmetic using a fictional data set to illustrate the mathematical principia to determine an intrinsic value? And I'd hope you include the comprehensive mental model of the key metrics considered, any qualitative assessments of the management, and any assumptions of its industry to determine the durability of its earning power. And Warren, same to that effect, would you also demonstrate or illustrate an arithmetic problem set using with a significant capital base and provide the object lessons on how those have changed from a small to a large capital base?
Well, I can't give you a formulaic approach because I don't use one. And I just mix all the factors, and if the gap between value and price is not attractive, I go on to something else. And sometimes it's just quantitative. For instance, when Costco was selling at about 12 or 13 times earnings, I thought that was a ridiculously low value just because the competitive strength of the business was so great and it was so likely to keep doing better and better. But I can't reduce that to a formula for you. I like the cheap real estate, I like the competitive position, I liked the way the personnel system worked, I liked everything about it, and I thought, even though it's 3 times book or whatever it was then, that it's worth more. But that's not a formula that anybody... If you want a formula, you should go back to graduate school. They'll give you lots of formulas that won't work.
This is the longest we've ever gone in the Berkshire meeting without Charlie saying that, getting to the point where he prefers Costco to Berkshire. Okay, Andrew.
We got a handful of questions relating to Apple. This is a bit of a mashup of a couple of them. Warren, you have bought in and sold out of IBM. You have praised Jeff Bezos but never bought Amazon. And you have doubled down on Apple. Can you tell us what it is about Apple? And given your sometimes critical views on buybacks, do you think Apple would do better spending $100 billion on buybacks or buying other productive businesses the way you have generally preferred? $100 billion is a lot of money.
I used to think so. Apple has a incredible consumer product, which you understand a lot better than I do. Whether they should buy in their shares, they shouldn't buy in their shares at all unless they think that they're selling for less than they're worth. And if they are selling for less than they're worth and they have the money and they don't see an acquisition that's even more attractive, they should buy in their shares. And I think that that's because I think it's extremely hard to find acquisitions that would be accretive to Apple, that would be in the 50 or 100 billion or $200 billion range. They do a lot of small acquisitions. And I'm delighted to see them repurchasing shares. Let's say we own 250 million or so shares. They have, I think, 4,923,000,000 or something like that. And mentally, you can say we own 5% of it, but I figure with the passage of a little time, we may own 6 or 7% simply because they repurchase shares. And I find it, if you got an extraordinary product and ecosystem, and there's lots to be done, I love the idea of having our 5% or whatever it may be grow to 6 or 7% without us laying out a dime. I mean, it's worked for us in many other situations. But you have to have some very, very, very special product, and which has an enormously widespread ecosystem, and the product's extremely stable. And they're not going to find 50 or $100 billion acquisitions that they can make it remotely a sensible price that really become additive to that. And they may find it, who knows? But there certainly, as I look around the horizon, I don't see anything that would make a lot of sense for them in terms of what they'd have to pay and what they would get. Whereas I do see a business that they know everything about, and where they may or may not be able to buy it at an attractive price when they repurchase their shares. That remains to be seen. Incidentally, that's one thing that I always enjoy. People say, well, you're talking your book or something if you talk. From our standpoint, we would love to see Apple go down in price. They're going to, well, just put it this way. If Andrew and Charlie and I were partners in a business that was worth $3 million, so each of us had $1 million interest in it, if Andrew offered to sell out his 1/3 interest at $800,000 and we had the money around, we'd jump at the chance to buy him out. I mean, it's so simple. But people get all lost, and if he wanted $1 million too for it, we wouldn't pay it to him. It's very simple math, but it gets lost in all these discussions. And of course, like I say, Tim Cook can do simple math, and he'd probably do very complicated math too. So we very much approve of them repurchasing shares. Charlie?
I think generally speaking in America, when companies go out hell-bent to buy other companies, they're worth less after the transaction is made than they were before. So I don't think you have a general weight of wealth for American corporations to go out and buy other corporations. Averaged out, it's a way down, not up. And I think that a great many places have nothing better to do than to buy in their own stock, and nothing as advantageous to do as as buying in their own stock. So I think we know pretty damn well what's going to happen to Apple. They'd be very lucky if there was something available at a low price that they could buy. I don't think the world's that easy. I think that the reason these companies are buying their stock is that they're smart enough to know that it's better for them than anything else.
That does not mean we approve of every buyback at all, though. I mean, we've seen.
No. Yeah. I think some people just buy it to keep the stock up, and that, of course, is insane and immoral. But apart from that, it's fine.
Okay, Greg.
Warren, if we look at the performance of your equity investment portfolio the last 3 to 5 years, some of the strongest performances come from Visa and MasterCard, which put up returns that were 3 to 4 times greater than American Express. Unfortunately, your holdings of the two names, which we assume were held by Todd or Ted, have accounted for less than 1% of stock holdings on a combined basis the past 5 years, while American Express has tended to be a top 5 holding, accounting for 10% of the portfolio on average and closer to 8% of late. Given that all three firms benefit from powerful network effects along with valuable brands, were there any particular reasons Berkshire did not ramp up its stakes in Visa and MasterCard to more meaningful levels, especially during those years when American Express was struggling? After all, you've shown a willingness to own several stocks from the same industry, holding shares in several competing banks and buying stakes in all 4 domestic airlines in fairly equal amounts when you picked them up in late 2016.
Yeah, when Ted and Todd, or either one of them, I won't get into which one of them specifically bought, or for that matter, they could both have bought Visa and MasterCard. They were significant portions of their portfolio, and there was no embargo or anything on them owning those stocks because we had a big investment in American Express, and I could have bought them as well, and looking back, I should have. On the other hand, I think American Express has done a fabulous job, and now we own 17 and a large fraction percent of a company that not that long ago we may have owned 12%. We've done it without spending time and without, it's a company that that has really done a fantastic job in a very competitive field where lots of people would love to take their customers away from them, but they have more customers than ever, and they're spending more money than ever. The customers are, and the international growth has accelerated. The small business penetration is terrific. It's really quite a business, and we love this, and we love the fact we own it. Like I say, it didn't preclude me from in any way from buying Master, Charger, or Visa, and if I'd been as smart as Ted and Todd, I would have. Charlie?
Well, we would have been a lot better in all of our stock picking if we could do it in retrospect. But at the time, we have a big position in American Express, and there is one tiny cloud on the horizon of the payments processors, and that is the system of WeChat in China. And so it isn't as though there isn't a little cloud somewhere off in the, and I don't have the faintest idea how important that cloud is, and I don't think Warren does either.
No, payments are a huge deal worldwide, and you've got all kinds of smart people working in various ways to change the payment arrangements.
To destroy what we have now.
Sure. And you've got some very smart people that that are building a company, and American Express made a decision a few years ago not to bid as low as somebody else did to retain the Costco business. And I think Charlie and I disagree on this, but I think it was a smart decision. He doesn't think it was a smart decision, but one of us will be right. And one of us will remind you that they were right. But if you look at American Express, it's a remarkable company. I mean, they came after them with Sapphire last year. People want that business, and payments are changing, and you can see in different countries different ways things are going on in that. And there are a lot of people that will play the game of gaming the system and switch from one to another based on the rewards on this card or that and all of that sort of thing. But there also is I think there's a very substantial group for which American Express does something very special, and they keep capitalizing on that premier position with that group, and they're doing it successfully around the country. And you'll see in the first quarter, you've seen in the first quarter, we're in Britain and Mexico and Japan, you're seeing gains of 15% or better in local currencies, and the base is not tiny, but it's not huge, so there's a lot of room left to go in that, and the small business penetration is good. The loan portfolios behave sensationally compared to really just about anybody. So I like very much our holdings of American Express. The first half, because of the accounting changes, they had to suspend their repurchase program for 6 months, but they've announced that they expect to renew it, and someday we'll own a greater percentage of American Express, and it'll be a bigger company, in my opinion, and I think we'll do very well. But as Charlie says, nobody knows how payments for sure comes out, and nobody knows how autos for sure come out. And that is true of a great many businesses we're in, and we've faced it before. We used to buy things that were certain failures, like textiles and second-rate department stores and trading stamps in California. Now we just face things that face real difficulty, so we're actually moving up the ladder. Okay, station one.
Mr. Buffett, my name is Daphne Collier Starr. I'm 8 years old and live in New York City. I've been a shareholder for 2 years, and this is my second annual shareholders meeting. Berkshire Hathaway's best investments on which the company built its reputation have been in very capital efficient businesses such as Coke, See's Candy, American Express, and Geico. But recently, Berkshire has made really big investments in a few businesses that require huge capital investments to maintain and that offer only a regulated low rate of return, such as Burlington Northern Railroad. My question to you, Mr. Buffett, is could you please explain why Berkshire's largest recent investments have been departed from your old capital efficient philosophy? And why specifically have you invested Burlington Northern instead of buying a capital efficient company like American Express?
You're killing me, Daphne. Yeah.
I'm certainly glad she's not 9 years old.
Yeah. I'm just sitting here thinking which of the 6 panelists we're going to bump next year and put you in. Well, I thought I was doing well when I bought that city service at 11. The answer is that we always prefer the businesses that earned terrific returns on capital, like a See's Candy when we bought it, or a good many of the businesses, and American Express, earns a terrific return on equity and has for a very long time. The fact that we buy a BNSF, Burlington Northern, means that essentially we can't get more money deployed in capital light businesses at prices that make sense to us. And so we have gone into more capital intensive businesses that are good businesses, but wouldn't it be wonderful if we could run the railroad without trains and track and tunnels and bridges and a few things? We get a decent return on the capital intensive businesses. We bought most of them at very decent prices, and they've been run very well since we bought them. We still love a business that takes very little capital and earns high returns and continues to grow and requires very little incremental capital. We can't deploy as much money as we have in doing that, and so is the second best choice still a good choice? The answer is yes. It's not as good as the best choice. Charlie?
Yes, I like the aspiration of that young lady. She basically wants a royalty on the other fellow's sales. And of course, that's a very good model. And if everybody could do that, why, nobody would do anything else. The reason we're satisfied with our utility returns and our railroad returns is they're quite satisfactory. Quite satisfactory. I wish we had 2 more just like them. Don't you, Warren?
Yeah, definitely.
So the answer is they're good enough, and you're asking us to get perfection. If you want us to have all our money in Coke at, say, 5% of what it's now selling for.
Yeah, and a business like Apple really doesn't take much capital, but it's still, you've got to spend a lot of money to buy businesses like that. Very few are for sale, and the answer is we have not foregone any opportunity to buy businesses that earn high returns, very high returns on equity capital, or when we could buy them at a sensible price, to buy these other businesses. So they haven't shoved anything else off the table. But you definitely have a job in our capital allocation department.
Okay, Carol. This question is from Max Taylor of Chicago, and it concerns the newspapers that Berkshire owns. In your 2012, you had a section devoted to Berkshire's buying 28 newspapers during the year just passed. Since then, you have not come back to the newspaper subject. But this year, at the end of the annual report, you published a list of the newspapers Berkshire owns today, along with their circulation. I compared that list with the one you published 5 years ago at the end of 2012. As you no doubt know better than anyone, the circulation of the 26 newspapers that Berkshire still owns, of the 28 originally bought, fell sharply, in many cases by big amounts, like 30% to almost 50%. I know that 5 years ago you acknowledged the risk in owning newspapers, but you still said, Charlie and I believe that papers delivering comprehensive and reliable information to tightly bound communities and having a sensible internet strategy will remain viable for a long time. Skip to today and imagine that you are writing about Berkshire's experience with newspapers. What would you be saying?
Yeah, I would say that I forget the modifying word on internet strategy, but I guess I said sensible. The problem has been about 1,300 daily newspapers in the United States. There were 1,700 not that long ago. Is that no one except the Wall Street Journal, the New York Times, and now probably the Washington Post has come up with a digital product that really, in any really significant way, will replace the revenue that is being lost as print newspapers lose both circulation and advertising. And if you look at the communities in which we operate, or the communities in which, you name it, other newspapers operate, the community could be prospering. We're in a prosperous economy presently, and all are losing daily circulation. They're losing Sunday circulation. They're using what's called street sales. They're losing home delivered, and I've been surprised that the rate of decline has not moderated in the last 5 years. We bought all the papers at reasonable prices, so it is not a great economic consequence to Berkshire. But I would like to see daily newspapers actually, be economically viable because of the importance to society. But I would say that the trends, which I put those circulation figures in there because I think shareholders are entitled to look year to year at what is happening, and it's happening to 1,300 newspapers throughout the United States, and it happens in small towns where you would think that the alternative sources of information would not be that good. It happens every place, and the Journal, the Times, and probably the Post have a viable economic model in the digital world, and probably will continue to shrink. I'm almost certain will continue to shrink in the print world, but the digital world will be big enough that, and they'll be successful enough so that they have, in my view, a sustainable business model. But it is very difficult to see, with the lack of success in terms of important dollars arising from digital, it's difficult to see how the print product survives over time, and I'm afraid that's true of 1,300 papers in this country, and we'll keep looking to see if there is a way to do it. But you'd have to look at our experience and look at the experience of everyone else's. McClatchy newspapers came out the other day, And I think the newspaper, which is very good, fine cities that they operate in, and advertising revenues down something like 17 or 18% in circulation. But it isn't just them; it's everybody in the business. And I wish I had a better answer for you, but I don't. I would say that the economic significance to Berkshire is almost negligible, but the significance to the society, I think, actually is enormous. And I hope that we find something. I hope others find something, because we'll copy it. But so far, we have not succeeded in that. Charlie?
Well, the decline was faster than we thought it was going to be. So it was not our finest bit of economic prediction. And I think it's even worse. I think to the extent we miscalculated, we may have done it because we both love newspapers and have considered them so important in our country. These little local newspaper monopolies tended to be owned by people who behaved well and tended to control the politicians. And we're going to miss these newspapers if they disappear. We're going to miss them terribly. And
I think
I
you
hope
meant
to God it doesn't happen, but the figures are not good, Warren.
No, they aren't. And it isn't just, it isn't some town that has a particular problem with unemployment or anything of the sort. And it isn't due to general economic conditions. It's due to the fact that in this paper, if you wanted to know the baseball results from the present day and the box scores and everything else, they told you the following morning, and it was still news to you. And the financial material that I read from there, in terms of looking at the stock prices and everything, they were news to you the following morning. And what was developing in the Pacific in terms of the war was news to you when you read about it in the morning in the New York Times. And news is what you don't know that you want to know. And those help wanted ads, segregated as they may have been, still were the place to go to look to find a job. And you can go up and down the line, and one element after another, where the daily print newspaper was primary, they're no longer primary. And the business has changed in a very material way, and we haven't been able to figure out any solutions to that, and we'll keep trying. And like I say, it's not of economic consequence, but I think it is societal consequence, and we haven't been able to solve it. Okay, Jonathan?
TTI has been a nice growth story since Berkshire acquired it 11 years ago, more than doubling its pre-tax earnings to about $400 million due to fine organic growth and at least 2 successful bolt-on acquisitions. Business momentum appeared to accelerate in the first quarter. Can you please talk about the competitive landscape in the electronic components distribution industry and what TTI's advantages are? Is it just a great industry to be in, or is TTI's business model and or management team special? Well, do you expect it to continue to be one of Berkshire's faster growing non-insurance subsidiaries?
TTI is run by a fellow named Paul Andrews, who's done an absolutely sensational job with us. He's a wonderful man. He's a wonderful manager. And in the last, he's quadrupled the business basically. But in the last year, and accelerating right to this point, they distribute little electronic components. They're a many billion-dollar business, and their average item is less than a nickel that they sell. So it's kind of like being in the jelly bean business or something like that, except these things go into all kinds of fancy machines that I don't understand. And we have a worldwide operation based in the Dallas-Fort Worth area, and built by one man who left a division of General Dynamics 45 or 50 years ago, and step by step build up this business. Like we just bought, within the last 2 months, we bought an operation in South Korea that will be another substantial addition. We do business worldwide. And electronic components have absolutely taken off in the last year, and they use something called the bill, well, it's essentially a measure of backlog, and book to bill is the ratio they call it, but it's just kind of a special term. But it's just improved dramatically in the last year, and it continues month after month. So something is going on out there, because nobody buys these things to store them in their basement or anything of the sort. I mean, these get used, these electronic components. Some of them are on allocation. We have a great relationship with suppliers. We have a very good relationship with our customers, because we carry more inventory than most of our competitors. So particularly when the business is tight, we can deliver and do a very first-class job doing it. So I give great credit to Paul. And he increased his physical facility, started on that a few years ago, and it's a godsend that he did it, because with the business going through there now, we wouldn't have been able to handle it. But it's a competitive business. I mean, if you look at Aero Electronics on the New York Stock Exchange, we've got competitors. I think Paul is doing a better job by a considerable margin than they are, and I'm delighted it's part of the Berkshire family. There will be times when that business slows down, because their customers will have their own cycles, and when it does, we'll go down. But over time, that business is going to grow. Charlie?
Yeah, it's a wonderful business because it's so difficult to do that competitors don't want to try it. When I lived in Omaha, there was a man who lived in great prosperity and almost no work, and his business was gathering up and rendering dead horses, and he never had any competitors. He used to come up to the Omaha Club and start drinking about 11 in the morning. It was not a difficult business, but nobody ever crowded him with new competition. And very few people want to distribute zillions of electronic parts that are worth a nickel each. It's very complicated. And of course, that business is terribly good at it, and it keeps getting more and more of the same. So you're right, it's a huge growth business, which is sort of the electronic equivalent of gathering up and rendering dead horses.
Imagine keeping track of close to 1 million different items, with very small values attached to them, and getting them out to your customer fast because they want them fast, all over the world, and those things are not easy to manage. I mean,
and staying in stock on so many items. It's very complicated, and that business is very good at it.
Yeah, we're lucky.
And of course it'll grow. The horses went away, but these parts aren't going to go away.
Charlie made a profession of studying businesses where the owners could sit around and drink all day and have them. He thought that was where we ought to be competing, but or buying.
My theory, Warren, is if it can't stand a little mismanagement, it's no business.
Yeah. Yeah, and we're testing that sometimes. Okay, station 2.
Hi, Ben Sherbert, Topeka, Kansas. Just want to say, Warren and Charlie, thank you again for hosting us all. This is a great event.
Thank you.
My question is about the recent decision to sell shares back of Phillips 66. Not to put you on the hot seat, but right after that, share prices jumped up about $22 a share. You mentioned seat, but right after that, share prices jumped up about $22 a share. You mentioned at the time that there's some regulatory requirements if you own over 10% of a company. Could you talk about the factors that go into how you decide whether to retain more than that or get under that threshold? And then what are your thoughts long term on Phillips 66, like their business midstream refining?
Yeah. Well, it was the city service preferred of last year. We sold the stock at around 93 or 4 and probably 115 now. But we own just under 10% of the company. And the more Ted and Todd and I think about various problems connected with regulatory problems and trading problems and so on, overwhelmingly we will stick below 10% on marketable security holdings. We've done it with the airlines. Now, that does not mean we're going to reduce our holdings in American Express or anything of the sort. And Greg Garland has done a great job at Phillips 66. We've had very good relations with the company. He's a very, very, very experienced and sensible manager. But I did decide that I wanted to be below 10% in that holding, and like I say, we'll stay just slightly under 10% of Wells Fargo. We've actually sold a few shares just to stay below 10%. In the case, I think, of both American Airlines and United Continental, we unless there's something unusual, we're going to stay under 10. But we have 9 and a significant fraction percent of Phillips, and I think they've been good at operations. I think they've been good at capital allocation. We traded them stock for a business some years ago, which has been a very nice business that we've retained an operation. So we've got a lot of money still in Phillips, and I wish I'd made the deal at a higher price. But we made money on what we sold, and we accomplished an objective. Charlie?
Well, we like the subsidiary we traded the stock for.
I missed that, but
We traded the stock for a subsidiary.
yeah. Well,
we like the subsidiary.
Oh, yeah. Well, it
It's
improved.
like the stock went away for nothing.
Yeah. Yeah, actually, we've done pretty well with Phillips. Becky?
This question comes from Vlad Koptev in Ukraine. He says, capitalization of cryptocurrencies approached that of Berkshire and Apple last year. And clearly the idea behind crypto will affect conventional banking groups where Berkshire is a shareholder. You always say you didn't go into too much detail to obtain an understanding on cryptocurrencies. So what factors caused you to say that it's a bubble?
Well, generally non-productive assets remain. If you had bought gold at the time of Christ and you figure the compound rate on it, it may be a couple tenths of 1%. It essentially is not going to deliver anything other than supposed scarcity, because you can only mine so many. But so what? I mean, what does it produce itself? The check is a wonderful idea. Just imagine how the world would be without being able to write checks or have wire transfer of funds. But it doesn't make the check intrinsically itself worth a lot of money. And if you said you can't use something called check with a little piece of paper, you'd do something else to transfer money. I think that anytime you buy a non-productive asset, you are counting on somebody else later on to buy a non-productive asset because they think they can sell it to somebody for more money. And it's been tried with tulips, and it's been tried with various things over time, and it does come to a bad ending. You have a hard time. You can think of raw land. I mean, the Louisiana Purchase was, say, $15 million for 800,000 or so square miles of land. In fact, you're sitting on land that came with the Louisiana Purchase, and so what we paid 20 bucks a square mile, and 640 acres in a square mile, and you're down to 3 cents or something. So that was a pretty good purchase of what was then a non-productive property. But it depends. But it's very hard. You can buy stamps. Bill Gross got collected a wonderful stamp collection, and it sold for more money in the end. But it's dependent on somebody else wanting to buy, hoping they will sell it for more money, and so on. And in the end, you make your money out of productive assets. If you buy a farm, you estimate what the crops, what amount per acre of soybeans or corn or whatever may be raised, and how much you have to